Hello and welcome to this lesson on the one shot, one kill trading model. Before we go into how to be successful with the one shot, one kill trading model, first of all, let's define what a one shot, one kill trading model is. Now, we're going to refresh some concepts from the previous lessons on this model. And a one shot, one kill trading model essentially is trading a short term trade in direction of your anticipated weekly expansion. Now remember, your lower time frame executions always stems from higher time frame price delivery. You need to have a clearly defined daily bias to have a successful short-term trading model career, or to build a successful short-term trading model career. So before we go into all the criteria and everything, we need to first go back to the basics and define the basics. Right, just like an athlete. If you look at the most successful athletes, they are the ones who can do the basic things extremely well and extremely efficiently. And that's why we always go back to the basics to build upon the understanding of the basics. So this is the part where you probably have to pause a couple of times, take some notes, because I'm going to run right through all the things we've talked about in terms of defining a short-term trading model. And you're gonna see it really is simplistic and straightforward, right? I'm not looking at any notepad or journal to run through all these things, right? Because I already know them offhand, and these are things that are really easy. So once you get the hang of them, it really is straightforward. Now, your goal with the short-term trading model is in an anticipated bullish weekly candle. So if you're expecting the weekly candle to expand higher in direction of weekly order flow, then you're looking to execute at or very close to your pre-anticipated low of the week, and then you're looking to exit your execution at a lower time frame premium array. It could be a 1 hour swing guy, it could be a 4 hour swing guy, it could be even a daily swing guy, or it could be a 1 hour premium, a 4 hour premium, but it always has to be a lower time frame premium array. Now, you don't need to execute or exit. Sorry, you do not need to exit at the exact high of the week. All you need is just that little portion of that weekly range expansion, and you're good to go for the week. Now, where a lot of people actually mess this up is when they try to overexert themselves with the model. This is where things starts to go wrong. And what I usually remind students, especially, is you have to realize, or you have to understand, that every single time you place on the trade, you are essentially opening yourself up to risk in the marketplace. The more trades you place, the more risk exposure to price. The lesser trades you place, the lesser the risk exposure in price. Once you're able to get the meat of the move for your anticipated weekly range expansion, you do not need to go back and look for more trades. Learn how to be satisfied gaining what you can from the market and stepping aside, which is where a lot of you guys struggle with, because you think trading weekly is like what you see on Twitter, where you're making 20% per week or 10% per week, which are all unrealistic standards. Okay, these are all things, or these are all returns that are not realistic, and you're only seeing the select few people out of literally hundreds of people each week who have exceptional results. And that's what gains traction, because that's the way social media works, right? That's what gains traction. So your perception of trading is, I need to make 6, 7, 8% per week to be profitable or successful. And that's absolutely false, because what you're doing is you're not going into prices, you're placing expectations of what you've seen online on social media. You're placing that expectations on price. And whenever you go into price with expectations of performance, a lot of times you end up not performing as well, because the market will always take advantage of that. Because at the back of your mind, while you're going through the motions and you're going through your analysis and you're applying to your execution, you're thinking about the 8% this person made on Twitter, and you're saying to yourself, okay, I could do better. I could do better than what the market is providing right now. So let me go in and look for more trades. And this is where the entire problem stems from. So in advance, before I continue with the model, what I'm saying is, you're going to struggle with this model because you're struggling with yourself, and you're struggling with your inability to be content. Okay, your lack of contentment is what will lead you is what will be your downfall with the model. That's essentially what I'm saying. Now, with a bearish short-term trading model, essentially what you're looking to do is you're looking to short or execute a sell very close to or at the anticipated high of the week, and you're looking to exit at a lower time frame discount. Now, remember, for each of these models, either buying or selling, you want to be doing them. For a buy, remember that analogy we use with the daily candle, where in the bullish daily candle, institutions will buy below the opening price or at the opening price, and then above the opening price is where you see the profit release phase, which is the expansion cycle. And that's where you get the actual delivery, and then the market goes into a premium where distribution will then occur from all the accumulated positions below the open price, and then the market will make the high of the day and then start to retrace and then close in price. And that same concept also applies to the weekly range or the weekly range profile. You're looking in a pre-anticipated bullish weekly candle. You're looking to execute a short-term long at or below Sunday's opening price, which starts the week. Now, what time specifically? We're talking about 12 a.m. midnight New York. Okay, a Sunday, not GMT time zone. We're talking about 12 a.m. midnight New York. That's what is the true week open for our weekly range, and we're looking at the false run higher in the bearish or in a pre-anticipated bearish weekly profile. That false run higher is an opportunity to sell. In the pre-anticipated bullish profile, that short run lower below Sunday's opening price, that's our accumulation phase. And then the expansion above Sunday's opening price is our expansion cycle or our profit release phase. Now, that essentially is a summary of short-term trading model. Again, you can see how straightforward this is. Now, for you to find success with the short-term trading model, you need to have a very strong foundation with the higher time frame premise. And you need to know very clearly what the macro conditions are. And this helps you pre-anticipate. I think I've said pre-anticipate so many times already. But this helps you pre-anticipate manipulation phase or cycles in lower time frame weekly profile. And you have a clear understanding of what price is doing. If you don't have a very strong conviction of the daily profile and how, or not essentially just the daily profile, of the higher time frame profile. Now, usually that's the weekly profile and also daily profile, not as much as the monthly profile, but the weekly profile and the daily profile. If you don't have a very strong understanding of where the next expansion phase or cycle should lead up or down into, it gets very easy to be manipulated by price engineering liquidity on the lower time frame. A very strong understanding of lower time frame manipulation and lower time frame expansion cycle stems from a very firm foundation of macro conditions and daily order flow. And this is the real important part of this lesson. Now, we can go through all the different protocols and checklists you need to go through for you to, utilize the model. But this is where it all starts from. And that's why I strongly believe that module 2, that's a really, really core. It's a core criteria for any trader wanting to trade with institutional trading. Alright, so to be successful trading the one shot 1Q model, you need to, number one, understand macro conditions using concepts taught from module 2. So this is actually meant to be module 2. If you're wondering what module 2 is, that essentially is where we went through high time frame price delivery and all the tools you need to, bring together for a very strong understanding of higher time frame price delivery. So I want you to go and revisit all the content. I think it's about 15 or so from module 2, where we went in depth into high time frame price delivery. And number 2, you also need to have a very clear understanding of what ipsa daily ranges are, what the quarterly shift is, and the PD array matrix concept. So now let's delve a little bit into the PD array matrix concept. What I'm seeing here essentially is you need to know exactly where the next draw on liquidity is for that week. Okay, or you need to know very closely. It does not need to be an exact PD array where the next strong liquidity is for that weekly range expansion. But you need to know in the general discount array or premium array for where price should be expanding up or down into. And once you can know that, you already know the directional premise. You already know what to do intra-week. And these are the tools. These are the small little things like this are what adds up into, I should say, things or understanding that builds a very strong analytical presence in price. And also lastly, you need to have a very clearly defined expectation of open interest in the commercial agent program to support your daily buys. Your technical analysis using PRA matrix and using order flow and using relative strength, they need to be confirmed with the fundamentals. And the fundamentals are seasonals, open interest, and the commercial agent program. Now, the commercial agent program is that hedging program within 6 to 12 months of data. That's what we're utilizing. We're looking for the hedging program by looking for the ISI in the last 6 to 12 months of data and the lowest low in the last 6 to 12 months of data, then dividing the range by half, and that half becomes our 0 point basis, and anything above that is net long, and anything below that is net short, which are all things we discussed in module 2, where we talked about high time frame trading concepts. Now let's go into the actual protocol, and then I'll use a live execution from last week to explain just how quickly you can run through the protocol. Now I want you to note very clearly that this is not a protocol. This is just a summary of what the general protocol for short-term trading will look like. Now, there are very specific protocols you can utilize for short-term trading, and that's what we're going to discuss after we're done, or after we've wrapped up every module. We're going to start creating models or building models, and then you can go in and select from any of those models utilizing your own personal trading. Now, the one shot, one kill trade procedure. So these are the checklists or protocols you need to run through in general. This is still a trading model, so you can use this in general for short-term trading, and these are checklists you need to cross off for your analysis before you go into execution. First, you need to do is you need to determine the current or potential next quarterly shift. That means where is price moving to for the next 3 to 4 months? Is price already started moving in that direction, or is price about to turn and move in a new direction? That's what you're trying to define. So essentially what I mean is, am I in a current quarterly shift that's bullish or bearish? Or is the market towards the end of a quarterly shift that's bullish or bearish, and about to start a new quarterly shift that's bullish or bearish? That's the question you're asking yourself. And what this does is that defines your macro direction and premise. So aka the next 3 to 4 months of price action, you already know what you're looking for. You're either looking for bullishness or bearishness, and in between that, obviously you're going to get retracement and everything, and there are ways to anticipate that. But you already know the general draw on liquidity over the next couple of weeks, and this is what you're looking for. And once you identify the quarterly shift, you already know you're going to find more weekly range expansion in direction of that quarterly shift versus against. So if you have a bullish quarterly shift, you're going to see more bullish weekly candles versus bearish weekly candles. And that is a very strong bonus, because that aids in your anticipation of high time from price delivery each week. Number 2, you identify the high time frame PD arrays in the IPTA data ranges. Now, we talked about IPTA data ranges, and now you can do the 20-day look back, the 40-day look back, the 60-day look back, and all that look back period does is it brings into frame where the next strong liquidity is on the macro analysis or for your quarterly shift. Okay, now I've mentioned this before, I don't generally use the look back period on my chart, because I can already eyeball the level or eyeball the price range and identify very clearly where the market is reaching up or down into. But if you're starting out, it is essential. And how do you want to use the look back period? You delineate your chart from the nearest daily close. Okay, so if I wanted to trade from Monday, then I'll start from last week's Fridays. This is currently a Sunday for me. So if I wanted to trade tomorrow and I wanted to use the IPTA data range, I'll start my delineation from Friday, which is the last daily close, and I'll do a look back of 20 days or 20 days, right? And what I'm looking for is I'm looking for all the high time frame PD area within the last 20 days, and then from that I'll go zoom out a little bit more and look for within the last 40 days of price action. And the reason why this is really fruitful in terms of your high time frame analysis, because that helps you identify where high time frame level fund liquidity would be resting at, which is key in terms of your high time frame price delivery. Because again, who are the central banks cannibalizing on? It's not you, because you don't have enough volume to affect the market. Okay, your volume is minimal or thin. It is the funds and the institutions, the large institutions who have open float liquidity risk in the marketplace. These are the people that the algo will draw price up or down into to go and cannibalize on. So by identifying the salient PD arrays in the last 20 days, 40 days, 60 days, which is what the funds are referencing for price delivery, you can anticipate where price should be driven up or down into. Number 3, you're also going to refer to interest rate differentials. I did not really cover interest rate differentials because this is a more long-term approach to price action, and it's a very difficult tool to fully grasp in terms of understanding price delivery. And in my opinion, it's not really that essential. Okay, in all my 6 years of, or not 6 years, not my 5 years of trading, I've not really used interest rate differentials more than 3 times, I think. I used them more during 2019, and then post 2019 I realized once you know what treasuries are doing, you don't necessarily need the interest rate differentials, because the interest rate differentials has a lag time. It has a lag time of about 6 months, right? So it could take 6 months for the lag time between the interest rate of, let's see, if the interest rate on US dollar is around 4%, and then the interest rate on Aussie is around 8%. Generally, you expect Aussie to rally against US dollar because it has a higher interest rate differential. But then sometimes you would see weakness in Aussie US dollar over a period of time before it eventually catches up. Sometimes it might be even over a year. And that's why I don't use interest rate differentials, because of that lag time. I'm not swing trading. I'm more short-term trading. So for a short-term trading model, you're more interested in the treasuries and interest rates, not interest rate differentials, but actually interest rate, which is an inversion of treasuries. That's where your focus should rely more on, and that's what you're focusing on in terms of anticipating where price should trade up or down into. Number 4, you scout seasonals throughout the year. Now, you don't go into every month looking for seasonals, right? The only time I'll use seasonals is when there's a very strong delivery for a specific month. So if I see a seasonal tendency whereby price is not delivering strongly, or there's no strong trendiness in price, I'm not really concerned with that seasonals, right? Because again, I'm looking for specific seasons during the year where there's a very strong willingness in price to displace in one direction, and then I'm using technical analysis to confirm all of that, right? So this is how you utilize seasonal tendencies. And you also look for currencies that are not willing. If there's a month, for example, let's say during the month of May, there's a very strong seasonal tendency for euro to see a massive increase or a massive rally higher, and you don't see that massive rally higher, then during the month of June, there's a very strong seasonal for euro to see a very massive decline lower. Then as you head into the month of June, because in a seasonal period where you were supposed to see a very strong rally higher, there was none of that. That means fundamentally euro is being accumulated for the sell side. And in a seasonal where there's a strong willingness, or it shows over a period of time that there has been massive decline during that season, when euro gets into that season, it'll freaking tank, because that shows an unwillingness during the very bullish seasonal to rally. So what's going to happen during the very bearish seasonal is going to freaking tank, right? So this is how you can also use seasonals to determine the strength or weakness of a currency. So essentially what I'm saying is you can use seasonal tendencies to determine the relative strength of an asset. Okay, contrary to what I taught you, or not contrary to what I taught you, but just in addition to what I taught you. Also, what you want to do is you want to conduct your swing analysis from the high time frame chart down to the 60-minute time frame. And what you're doing is you're essentially going from the higher time frame, looking at the overall weekly profile, and then you're building that down to the lower time frame. Again, like I've mentioned before I started the video, you need a very strong higher time frame understanding to go into the lower time frame, that's the 1 hour time frame, and have a very strong understanding of the manipulation play and the expansion phases on the lower time frame, and also understand the general liquidity in the lower time frame, because a lot of times it's very easy to get so caught up, and this is the mistake a lot of individuals make. They get so caught up on the lower time frame price delivery that they lose perspective of what the higher time frame price delivery is actually doing. So I'm going to break this video into part 1 and part 2. We're going to end this one here, and on part 2 we will continue from here and go into the actual trade idea from last week using what we just talked about. So I'll see you all on part 2, and enjoy for now. Let's keep the video short, so it's going to be 2 parts, part 1, part 2. We're going to keep this one short, and then the next one is going to be also a short video, so that way it really is straightforward. I'll see you on the next one, and trade safe.